Stieglitz joins us now, Steve, with the latest results from the Fed survey.
Yeah, latest and most complicated ever, Joe. Market expectations have turned aggressive for the Fed compared to the last CNBC Fed survey, with respondents looking this year and next for multiple rate hikes and significant balance sheet reduction. Here are the Fed expectations. The Fed first hike now firmly seen coming in March. 3.5 hikes are forecast this year. That shows that 3 are baked in, and the debate now in the market is whether there's a 4th this year. An additional 3 hikes expected in 2023, and the balance sheet runoff seen beginning in July. That is much earlier than the prior survey. Now, we don't know much about how the Fed is going to run off the balance sheet. Here's the first look at how respondents think it could happen. They look for $380 billion to come off the $9 trillion balance sheet this year, and $860 billion in 2023. While most think it's going to be phased in, that is, they'll increase the amount of the runoff as time goes by, the average respondent looks for a monthly runoff pace of $73 billion eventually. That is far faster than the last time the Fed did this in 2018. Over about 3 years, the average respondent looks for $2.8 trillion to be run off, or about a third of the balance sheet, over a 3-year period. And of course, we'll listen to Fed Chair Powell's press conference on Wednesday for any guidance on both the pace the Fed is actually considering for balance sheet and rate hikes. Here's the long run look at the Fed funds rate. Just over 1% this year, 1.8% next year, and the terminal rate now pegged to be hit in March 2024 at 2.4%. So quarterly hikes are looked for, at least for this year. Asked if the Fed is moving too fast or too slow, 91% of our 36 respondents say the Fed is significantly or somewhat late in addressing inflation. One more point worth considering. While the outlook for Fed tightening has increased, as has inflation, the outlook for unemployment went down, and the forecast for growth, Joe, went up.
Steve, you've seen some of the layest about do you have any immediate data points on how much slowing we're seeing, given I guess it's because people are calling in sick. We know Omicron, the hospitalization may not be what Delta was, but a lot of people, I guess, aren't at work, and that actually makes a difference on output.
Absolutely. And obviously inflation. We saw some of the supplier surveys slow down. We saw a Chicago survey slow down. Some of the Fed manufacturing surveys have been okay so far. We'll wait to see, Joe. I think the market understands that there was some slowdown in December and in January, and the expectation is that things pick back up in February. I think, to my mind, when I look at the overall economy, I'm really interested in what happens in China, right? Because you have the Lunar New Year, which is a big rest period or vacation period for the Chinese. And also you had the Omicron shutdowns there, which are much more severe than we have here. So that's an issue for supply that could hit us a couple months down the road. But the expectation, I think, Joe, and you talk to as many people as I do, probably more, about this stuff, is that by sometime in February or March, things will get going back again from this Omicron variant, assuming we don't have another one.